So we're going to continue. This is the 24th. Okay, so this was our last session. So in the last session, we covered the two, just as a quick recap, we covered the two remaining important decision problems that you have to solve under the buy-sell umbrella for option trading. So under this buy-sell umbrella for option trading, there are four decision problems, whereas in spot trading, there's only one, just to decide the buy-sell bias. So under options, you have to decide whether you're a buyer or seller of options, whether you want to buy and sell put, call or put options, and you also have to decide the expiry date and the choice of strike. Okay, so you got these in yellow: expiry date, choice of strike, and these should be taken in sequence. So first you decide whether you're a buyer or seller of options. So here you have the additional decision problems in option trading. Make sure you understand all the fundamentals very clearly, because this will be your basic theoretical framework for doing your project. So you have this. So you proceed in this sequence. First, decide whether to buy or sell options by looking at the eyeball index chart. I'm repeating a little bit of this, but just as a recap, just to refresh your memory, because it's very important. Right? So you look at the eyeball chart, form a view on the eyeball. That tells you whether you want to be a buyer or seller of options. Then you take a look at the underlying price chart. Here it's Microsoft, and decide whether the underlying is going up or down, according to you, in the future. That helps you to decide whether, having decided this, then what about this, whether you want to be a buyer or seller of calls or puts. For this, you have to form a directional view on the underlying asset. Okay. So once you do that, you get into the eyeball, that matrix that I've shown you. Let's see if it's in your, maybe it's in your calc file. We'll just launch it straight from here. You've already seen the matrix, which is this one. That takes you into the matrix, so you know immediately whether you want to be what are you doing? Are you buying calls, selling puts, whatever it is, you know that. Then after that, you have to further decide the expiry date, and then after that, you decide the strike. Okay, so you should follow this sequence. Later on, when you become a proficient option trader, you can do your own framework, you can do your own thing. At this point, I'm giving you the structure. This will help you to proceed because you're very new to option trading. So these are the four that we have discussed over the last two sessions. So this is the most important part of the theoretical background for this project. Okay. So now we'll move on from here to the next topic. Now it will get a little bit theoretical, but it's very important to understand the theory properly, because that's what helps you to operate in the real world. Okay, so I've given you some links here. You can look at those links. Some of these may actually, this is Yahoo Finance. This is for the underlying market. These are the links to the Yahoo Finance charts, and these are the links to the CBOE. I don't know if this still works. I think this link is not working anymore. They have put it on hold for a while. Yeah, this is actually not working, but you can use this chart actually. So you can use this chart, and just giving you some links to form the directional view on the underlying market and the directional view on the implied vol index. Okay? So these are the ones that you're focusing on. That is, you're already used to this part from your previous project. Okay, so it's options on the underlying market, and then you have to do these four. Okay, so here I'll just teach you a little bit about some of these indices that you can use, which is, and of these four, essentially, these are going to be the two most important decisions. If you look at these four here, I'll put them kind of together. Underlying market view, first is the eyeball index view, then the underlying market view. Actually, we should put this in on top here to maintain the same sequence as above. first you form the view of the underlying, whatever the underlying market is that you're following. Take the implied vol index for that, and then form a view on the I-vol index, where it's going in the future. Then you form a view on the underlying asset price, which way is that going, and then you go to the expiry date and then the strike. Okay, so of these four, I would say that the first two are actually a little bit more important in terms of determining your profitability. Even this is important actually. These are all important, but because the different strikes, the prices will move differently. So these are all important, but these two are the most important, I would say. So I've given you some chart links. That will not work. Okay, so the implied vol index. Let me just give you this link for this one, and let me see what the link is for here. See what this link is. Okay. So here we'll talk a little bit about the VIX and the SPY. Okay. So you might have heard of. Has anybody heard of this thing called India VIX? Has anyone heard of India VIX?
Yes, sir.
You have? Okay. What is India VIX, Aman?
I have practiced aptitude questions from that only.
Sorry, you practice what? Aptitude questions.
IndiaVix.com is a practice site. You can practice aptitude for your interview. It helps in interview process.
Oh, okay. No, that's not. Maybe then that's not. So did it have anything to do with stock market?
No, sir, that's a different website. IndiaVix.com.
Okay, so that's anyway. So this VIX is actually a trademark name. Okay, so it's like quality ice cream or whatever. So it's a trademark name. So this thing that you see here, this VIX, is taking a little time to load. And this here is the syntax for Yahoo Finance, where for every index, for all kinds of indices, you have to give this caret sign. This is just a matter of syntax. You go to a different website, you'll have a different syntax rule. So this you can. What this VIX is actually a index of options on the S&P 500. It's an index of options on the S&P 500 index. All right. So it's an index of options. So the reason, if you see here, the reason I keep talking about I-vol index, the reason for that is, even when I've shown you charts like this, there seems to be some kind of problem here. It didn't load properly. No, it's not loading properly actually. Okay, never mind. We'll use this. So maybe there's a problem with my internet connection. I don't know where the problem is, but anyway, we'll use this. So the reason I'm saying index here, okay, when I'm talking about, you might wonder why I'm talking about index here. The reason I'm talking about index is these I-vol charts that you see. These are not the I-vol prices for one particular option. If you remember a few sessions ago, Siddharth was asking about whether or not we should track the I-vol, the prices of one particular option, the one that we are interested in. Because in practice, when you buy or sell something, you're going to be very specific. You will be buying maybe the at the money strike 3-month Microsoft call. So that's very specific. At the money strike is very specific, whatever the price is at that time, maybe $300. So you're buying the 300 call for 3 months on Microsoft. So that's very specific. That's a very specific option. But as you have seen with Yahoo Finance, that that there are many options trading on a particular security, even for one maturity. Even if you lock down the maturity, there are many options trading for that maturity. So therefore, it's not so simple to track option volatilities for each option, because you have so many different options trading for each, even for one maturity. And then you have different maturities even for one option. So if you just look at Microsoft, you'll have multiple maturities, and then you'll have each majority you have multiple strikes. So which option ball, eyeball are you going to take? And as you saw on the TWS, the eyeballs for the different strikes can jolly well differ. So this eyeball chart that you see here, typically on a software like this, on tracking software like this is actually an index of eyeballs of different options on the same security. The reason it's index, remember, index is just an average, okay, with some kind of averaging formula, either arithmetic mean or geometric mean or harmonic mean, whatever you want to use. You specify the formula, weighted average or unweighted or equally weighted average. This is just an average of option prices. So that's why I'm using, so the reason I'm using this word, in case you get confused by it, this is an index. Okay, so whenever we look at eyeball charts, generally, we are looking at an index of eyeballs for different options on that particular underlying asset. Because there are so many options trading, and if you wanted to track the direction of eyeballs, you would have to use an average kind of figure, which is an index. Okay, so understand that even these eyeball charts, these are actually indices. So the VIX is one of the most important. There seems to be some real problem with this. I don't know where the problem is. Is it at the website or? Yeah. So as I was showing you, even if you look at November 27, in the case of Microsoft, there are so many. Even if you take a straddle view, as you can see here, there are so many options trading. There are calls and puts, and there's so many different strikes, so many options. How do you track the eyeballs of all of these options together? You can't, it's not practically possible. So you use an average, which is in stock markets, we use a term called index to refer to averages of stock prices. Okay, so it's the same problem. If I wanted to look at everybody's grades in the class, maybe it's too confusing. There are too many students. So what I do is I compile an average grade for the whole class, and then I look at that, and that helps me to quickly get a picture about the underlying situation. Right. So just to point out that this is actually these are all averages. These eyeball charts, these are actually eyeball indices for options on that particular underlying asset. So that's why I'm saying that, but it's important for you to understand that as well. That's an important learning, that the eyeball charts you look at are index charts actually. So I wanted to just give you some charts here now. So the CBOE is also not working. This VIX is also, I don't know where the problem is. Let me see if there is any improvement with the VXN. Is it just maybe it's a Yahoo Finance problem, or maybe it was okay. That's great. So this is much better. This is the VXN. Now, what is the VXN? We can replace this. Okay, this is not working. This is the VXN, and this is the underlying market. So this we will change. We will change this into. This is also VIX. Now let's make this. Okay, I got this. Okay, and so this we'll have to do this. Okay, so this will be here. Okay, so I'm just making this. So I've tried to give you long term and short term. I've tried to give you. Now this will launch the VXN chart, if I'm not mistaken. We should launch the VXN chart. Okay, so here on implied volatility, I'm just trying to give you some charts. Okay, so this is not really a lot of theoretical knowledge, but it still gives you contextual knowledge on the market and how to track it using different charts and different indices. This is also useful for you from a practical standpoint. So understand what I'm trying to do. So that VIX was not working. So I had earlier given my example with respect to the SPY, okay, for which the index, the eyeball index is the VIX. I'll explain all this later. But since the VIX chart somehow is not working, I changed it, and I've changed my underlying to QQQ, okay, which is, so SPY corresponds to the S&P 500 index, and QQQ corresponds to the NASDAQ 100 index, okay. So if you remember here, now this is the NASDAQ, this is the QQQ trust. This tracks the NASDAQ 100 index. And this is our underlying asset prices chart. Put that here. for long term. Okay. Direction of view on the underlying market. This had been set as SPY. I'm going to change this to NASDAQ. Okay, you have this ticker also in your options list. And here, this we can just keep a short-term chart. We can just use the same chart actually. You can just use a short-term chart, or you can use this. We can change this to. Okay, so there's a little bit of learning about. Let's just we'll talk about Black Friday later on. Anybody knows what Black Friday is in the markets? With respect to the US retail industry? You should be
on Black Friday, sir.
Sale of goods.
Heavy discounted.
Friday before the Christmas or after the Christmas? I am confused about that. They offer a heavy discount on everything.
Okay. We'll come to this Black Friday discussion a little later, but I thought since it came up, because I don't want to get disorganized, we'll ask you this. So essentially, this Black Friday is. I'll just let you. So it's this is the first Friday that they go into the black, the retailers, because generally the whole year they make losses. In the holiday season, they go into the black. That means that red. Your earnings are in the red. When you are making losses, you say you are spilling red ink, because losses are written in red ink. So this is called Black Friday because this is the first day, which is basically the Friday around Thanksgiving, I think, the first Friday just before Thanksgiving.
Following that Thanksgiving, sir.
It is about Thanksgiving.
Yeah. So this Black Friday, the retailers go into the black. Okay, so that's why it's called Black Friday. So you should, as I've told you, you must develop detailed knowledge of the US market, because it's the biggest market in the world, and it will remain so even in your lifetime. Okay, there's no way China or India is going to overtake the US. Not in your lifetime, at least. So because they're not even following the right policies. So you must get a good understanding of the US market, because it tells you how a developed economy works, what it looks like and how it works. So that's good for your own knowledge. Okay. So this is, I have kept it as QQQ, and this one we'll just use this. So I get distracted in this way but every time I see something, I feel like I should, make sure you guys learn about this. So this is we'll make this, I don't know if this actually retains the tickers when you copy paste. I don't think it changes the ticker. It's a different kind of scripting language here. But anyway, so what you have to do is here you have to put QQQ. You can use short-term charts. This is much better. So you can do this. Here, what I'm talking about is just giving you some practical tools. And when you go there, this is a long-term chart. So this LT is long-term, ST is short-term. So when you're trying to form the directional view on the underlying market, this is Yahoo Finance long-term chart on the QQQ, which is tracking the NASDAQ 100 index. Right, this is where it is now. And this is the long-term chart. And then for the short-term chart, you can go to, I've given you the link that will launch, this link will launch the trading view charts. And then from there, you can go there and look at QQQ, and you can actually maybe put in slightly short-term charts like a 60-minute chart, which will give you much greater granularity over a shorter time. The data range will become shorter, but you have much greater granularity by looking at an hourly chart, because this chart is actually a daily chart. This is a daily or probably a weekly chart. So because it's very long term. So that's for your chart for the underlying market, the chart links. And on the eyeball index, this is where you'll get some idea that this is long term. And I think I've now put the QQQ indicators here. All right, let's show this. Yeah, it's launching the VXN. All right, so here what happens is this VXN. Yeah. What is this VXN? Now, VXN is again, you have to go to the end. Now, you notice, sorry. Now, the VXN is actually the eyeball index, okay, for options on the NASDAQ 100, okay? So understand this options on NASDAQ 100. We can write this here actually so that you have to know. This is a little bit of your institutional knowledge, contextual knowledge. Eyeball index for options on the NASDAQ 100 index. Okay, so the NASDAQ 100 is an index of stock prices of leading stocks that are listed on the top 100 stocks listed on the NASDAQ exchange. Okay, so this is an index of, these are both indices, so it's like an index of options, index for options on the NASDAQ 100 index. So the underlying is also an index. Here, this index consists of spot instruments. Okay, it consists of common shares trading on a spot basis. So this is your underlying asset market, and then you have options on this basket of stocks. Okay, so these options that are trading on the NASDAQ 100 index, these are options on the basket of stocks, which is represented by the NASDAQ 100 index. So these are spot instruments which form the underlying for the options. Okay, remember when we discussed various underlying for options, you can also have other types of underlyings for options. You can even have options as the underlying for options. Those are compound options. So you have to be clear what the underlying, what type of instrument is the underlying. In this case, the underlying is a spot instrument. And here you have a bunch of options trading on the NASDAQ 100 index. Obviously, so you as I told you earlier, you can have many options, many maturities, each maturity, many options. So which one are you going to track? The way you solve that is you create an index for options, okay? You create an index for the options, which means you take an average for those options, and you take an eyeball average for those options, and there you create your eyeball, and that is what gets plotted over here. Okay, so when you're trading options on the QQQ, okay, that is one of your because remember the connection between this and the QQQ is that these options are on the NASDAQ 100 index, and the QQQ is also tracking the NASDAQ 100 index. All right, so this QQQ is an ETF which is tracking this NASDAQ 100 index. So therefore, it's logically okay for us to use the VXN, which is the eyeball index for options on the NASDAQ 100 index, to trade options on the QQQ, because basically this is almost identical to this effectively. There's a scaling difference, but effectively it's the same thing. Okay, so this will track this, so we can logically use this. So these are our two important tickers. I'm just giving you one example. Okay, so there are some other indices that are there which you can take advantage of, where you can get long-term data essentially. Because the main problem here is eyeball long-term data is very limited. So we are not just trading to complete our project. We are also trading to learn how to trade options for the long term. So when you trade options for the long term, you're not going to have the restrictions that you have in this project. This project will finish in 4 weeks, okay, because of the limitations of our curriculum and all. We have to release the grades on time. Actually, I was in favor of, I wanted ideally to have you guys trading your 3 projects simultaneously for a year. Or, I mean, as long as possible. Maybe the third one can't trade for a year, but several months. But that would mean that the grades can't be released on time, I mean, in the way that you get them now. But, you know, I don't really think grades are that important. Learning is much more important than grades. But it's very difficult to get everybody in an institution to think. That's a very unconventional way of looking at things, and people don't agree. So that's why you're essentially feeling that your project is very cramped. But you have to, I mean, we can't do much about it. But what I'm telling you is that in an ideal world, we would be trading these projects for much longer, because to me, grades are not important. Learning is important, and that's how you learn, by doing these projects. So In the real world, you're learning for the real world. So in the real world, you won't have this 4-week constraint. So you have to practice trading for long-term, for longer-term horizons. And for that, long-term eyeball charts are very important. So now NASDAQ, Microsoft is a tech stock. Okay, so it will track the NASDAQ 100 index. So I'll show you how this exactly becomes useful. Is that when you look at the tickers, so essentially this is what you do. If you are trading options on the QQQ, you use the VXN as your eyeball index. Okay. And here I've given you the links to the QQQ. And when you launch this, you get the trading view charts, and on the trading view you put in the QQQ ticker, and you can get a short-term chart of the QQQ. So this is as far as trading options on the QQQ is concerned, which is already your ticker in the list of tickers given to you for the project. So when you have to form a view on the eyeball index, you will use for long-term eyeball charts, you can use the VXN. And in the short term also, I think this one has to be changed, because this link is not working. For the short term, what I'll do is I'll make this QQQ, and you have another charting source. So in case something happens to the first charting source, or you have a slightly different view, so here you can look at options on the QQQ. All right. So this is okay. So this also is just like the scripting language is similar to the one on the trading view chart. So you don't directly launch the QQQ when you click on this link, but you get to this website, and there you have to put in this ticker box. You have to put in this ticker box. You will have to put in this is your calc file, right? So in this ticker box, you have to put in your, here you enter your QQQ, and then it will give you this chart. This is a slightly shorter term chart than what you get here, okay? So, yeah, so this will also give you the VXN kind of plot. It's the same plot as the VXN plot. You will see that it will look similar because they're tracking the same thing. Right, so this is just long-term and short-term charting links. So there's not a lot of conceptual information here which I've given you so far. It's mainly contextual, okay, but just to show you how, the practical difficulties of coming up with long-term data on charts, and we also want it for free. We don't want to be paying for the software. So it's a little difficult. So you're learning a little bit about that as well. And that's also useful knowledge for people learning about financial markets. Okay, and then you form for the directional view on the underlying market, you use these links I've given you. So now these are consistent. They're all concentrated on the QQQ, not the SPY. Okay. Right, so once you've taken these two decisions, you have a view on the eyeballs, you have a view on the underlying market, you know where you are on this matrix, okay? So wherever you are, maybe you're on sell call, and then you have to go on and solve your other two problems, the expiry date and strike. For that, I've given you the information in the last session, okay? So this, unfortunately, the VIX link is not working. So for the SPY, as I've shown you, when you're trading options on QQQ for long-term eyeball data, you can use VXN as a ticker. And if you are able to make that link work, that chart is working on Yahoo Finance, then it will be, for the SPY, the corresponding is VIX, okay? So you have to use, in Yahoo Finance, you have to write caret VIX. Okay? When you launch this link, you'll automatically see the caret. So you have to write, notice this caret here, this one. So when you go for caret, you have to write caret with a caret, then you have to write VIX. Then it will show you, okay? So that's the thing. And okay, so there is another one actually, where we have standard tickers. So this is for SPY. Let me make this board. VXN and our VXN, I've already shown you. VXN applies to QQQ. And so you have another one, which is RVX, which is for IWM. Okay, IWM is the Russell 2000 index. Okay, this is again another idea of what you can learn by focusing on developed markets. In the US markets, you see many indices, and they're tracking different types of stocks. So the Russell 2000 tracks small cap companies. Okay, and the corresponding, so you have this as one of your tickers. This is an ETF that tracks the Russell 2000 index, small cap companies. And the RVX is the eyeball index chart for options on the IWM. Okay, so for 3 of your tickers, you have ready-made, you can have long-term data. And so one of the ways you can use this for other stocks, like you have some other stocks in your portfolio, like maybe Microsoft is one of your tickers. You can find out what the tickers are. I'll just give you some examples from there. I think maybe certainly Twitter is one of your tickers. Yeah, Microsoft is also one of your tickers. So you might think that, okay, so for Microsoft, I only have long-term data. I don't have I only have short-term data. I don't have long-term data for eyeballs. Okay, so the way you can use this is another trick that I'm just teaching you here, is that you only have long-term data going back to about Jan 19. What about before Jan 19? How were eyeballs behaving before Jan 19? So for that, you understand that Microsoft is a tech stock. Okay. And the NASDAQ 100, this is where your knowledge comes in, or your contextual knowledge becomes important. You know that the Microsoft is a tech stock. NASDAQ 100 index tracks technology stocks. So you can actually use long-term VXN data to fill in the gaps for Microsoft almost effectively. It's like, it's not really data for Microsoft options, but it's data for technology stock options, okay, as in options on the QQQ. So you can use the VXN, okay. If you want to look at the VXN, do we have maximum data here? Yeah, I think we have maximum. And I think maybe you can, because the, these charting types, this for eyeball, it's best to make it line, because you don't really have, there are some display problems nowadays on Yahoo Finance, but you can see here that this is, so here you can see certain types of data, like here you can't go beyond Jan 19 in Microsoft, okay? You can't go beyond Jan 19. So, so here what you have, therefore, is basically November 2018, late November 2018. That's the end of this data series. It starts from that point. But if you want to look at longer term data for VXN, for the eyeball of Microsoft, you want to plot it. You don't have the data, you can proxy it with VXN data, because Microsoft is a tech stock. So with VXN, you can go, this is where it is starting for your that chart, okay? But for this, you can go back here. You can see that VXN eyeballs were so much higher. So in comparison, right now this high is here at 322, okay, which is this 322, this spike here. This is much lower than the historical spike earlier in 2008. So you can see that, okay. So that's an interesting piece of information, that when option prices rose at the time of the 2008 credit crisis on tech stocks, option prices on tech stocks, they rose much higher than they did during the COVID crisis. That's an important piece of information. You can get that from the long-term charts, which you can't get from the short-term charts. So this is one way of doing. So this information may not be very useful to you in your project, but it is useful for your future if you end up doing option trading. How to use index eyeball charts for a technology index to proxy the long-term data for eyeball on a particular stock, which happens to be a tech stock like Microsoft. Okay, and you can use this for other stocks also, which are part of your. You can figure out that, okay, say AT&T, Disney, these are actually GE. These are parts which are going to be Micron. Micron is actually a tech stock, so I should not put it here. Micron is a tech stock. Then these are all tech stocks actually. Bank America is not a tech stock, and this is pretty much it. Everything else is a tech stock. Okay, you can say Facebook is not really a tech stock; it's a media kind of stock. So anyway, so these are the other stocks. Now these you can use the SPY. You can use the SPY to proxy these. The eyeball data of the SPY can be used to proxy long-term eyeball data for these tickers, okay? Because you will not have data going beyond November 18, late November 2018 through this website, okay? So this is just kind of not much conceptual knowledge, but just giving you some tricks on how to track the data, okay? So we'll go on to the next topic now. And here, as I've given you the, just to give all the decision problems together, after you choose this, after you buy the option, there is a further decision problem, which is, should you do early exercise for American options, or should you reverse the option position in the market? Now here there is a theoretical component to understand, okay, which the point is, what I'm saying is, theoretically there is a decision problem here, because in the case of American options, you can do early exercise. So the question is, should you do that? Should you exercise the option early, or should you reverse the option position in the market? Okay. So here too, I've said that you should generally, especially when you're trading options and not trading the underlying, you should just focus on the 5.2 and not so much this, because generally people don't do this early exercise even for American options. And the reason they don't do it is, if you think about it, go back to the same fundamental equation that we have, which is that option premium is equal to what? Intrinsic value plus what? Anybody? Time value? Okay, so I'm telling you this because it's a little bit difficult in an online session to visually interact with the class. But anyway, so you remember that the option, this is a very fundamental equation which we have to always remember. Okay, it comes in very handy conceptually in many, many situations. So the question is, so what I'm telling you on this is also a decision problem, right? For option trading, this is on a liquidation front actually, not on the buy-sell bias front, not related to that problem. But after you bought the option, when it comes to liquidation, there is this question theoretically. But in practice, usually people go for 5.2. And why is that? If you remember, so we can put this a little bit down here. Okay, the option premium consists of intrinsic value and time value. All right. Now, one of the things that happens is, if you look at a very out of the money option in for American options, okay, it will not have any intrinsic, or it'll have IV will be 0 because it's out of the money. Okay, but it will still have time value. We have seen this before, right? So what happens is, if you see this, is I think it's useful to have this discussion, because this is a conceptual discussion now actually. This is no longer talking about contextual information. This is once again conceptual, because you have to understand, why is it that people don't do early exercise even for American options? Why? Well, the answer that I'm giving you is that because if you do this early exercise, you lose the time value of the option. Okay. Whereas if you do 5.2, you will not lose that time value. Okay, so what happens is, let's look at this option price. Let's take an option, which is, let's focus on the call option. Okay, so let's take a longer term option so that we get more time value. Okay, let's make this 90. Okay. Because you would not exercise this option because the underlying price is 90 and the exercise price is 100. So, but the point to understand here is, if you look at this option price, the call, we'll focus only on the call. Okay, the call is 148. Okay, now this 148, can you see that this option does not have any intrinsic value? Because the market is 90 and the exercise price is 100. Okay, so why would you buy something at 100? And if you, essentially the logic for figuring out intrinsic value is buy the option, exercise the option, and sell the underlying that you get by exercising the option in the underlying market. and see if you make a profit. If you make a profit, that's the intrinsic value. If you don't make a profit, whether it's zero profit or negative, in both cases you say IV is 0. All right. So here you can see that this option has no intrinsic value. Okay, but it's still, so this 148 is completely made up of time value. And this time value, well, once again, if you see another trick, if we make this maybe let's double the ball, really see the impact. I'm not changing anything, okay? Out of the money option remains an out of the money option. Everything remains the same. So one thing we know is that the time value, the 148 is completely made up of time value, because we know that option premium is equal to intrinsic value plus time value. Here IV is 0. So this is equal to 148. Therefore TV is 148. Okay. Now, I'm going to double the ball. See what happens to the time value. You see what happened to the time value? So this eyeball, if it increases, even for an out of the money option, the time value jumps up. Okay. So this again demonstrates to you that the time value is an increasing function of is directly proportional to the eyeball. Okay. So the point here is that even if you have an in the money option, then the question of exercise arises only for in the money options. So why don't you do early exercise? Let's look at that. Okay. So let's take an in the money option. Let's say 110. Okay. Okay, let's look at 110 and let's calculate here. Okay, we've already done the calculation. Right, so look at this. 90 days, 100 call. Eyeball is 50. 90 days, 100 call. Underlying is at 110. Okay, so what is the intrinsic value of this option? Let's ask some people. Umar, can you tell us? What is the intrinsic value of this option? What happened? Anything? If your mic is not working, you can respond to me on chat. Umar is not responding. Okay, so let's ask the other Janvi. Janvi Singh, you can tell us. Can you tell us what is the intrinsic value of this option you're looking at? Okay, both Janvis are sleeping, or okay, somebody is responding. Yes, okay. You said yes, sir. What is the intrinsic value of this option you're looking at right now? The one I'm showing, the call. Show me the intrinsic value of the 100 call. Okay, great. So Janvi has correctly answered it. It's $10. Okay, the intrinsic value of the Janvi sorry, I was going to say Janvi call. Okay, the intrinsic value of the 100 call here is $10. Okay, but you notice that the time value, and so let's ask somebody else. Very easy question. Okay, let's ask Akshita. What is the time value of this option of the 100 call? What happened? Akshita is not on mute actually, but she's not responding. So all these cases, these all will go into the little black book where your CP scores will be deducted. Okay, let's ask Sonal. What is the time value of the 100 call? What happened? She's also not responding. Okay, who is this? Yeah, but okay. So Ummat has now responded. Okay, but anyway, let's look at. So I asked Sonal. Solar is not available. So let's ask Raghav. Raghav, what is the time value of this 100 call? Raghav is not available. We have more people on chat. Okay, fine. Yes, Raghav. I have to keep the chat also open. Raghav is not responding. Okay. Okay, who should we ask? Okay, let's ask Vipul. What is the time value of this Tali has raised? We'll just go with Vipul once and then we'll ask Natali.
Sir, what is? Can you repeat, sir? What is the
Question is, what is the time value? You're looking at a particular option on your screen. It's a 100 call. I'm talking about the call option. What is the time value of the 100 call?
sir, time value of 100?
This is referred to as a 100 call. Okay, so get used to the lingo of option markets because the exercise price is 100. So we would refer to it as the 100 call, the 90-day 100 call, because we just use the exercise price and we call that the 100 call or the 200 call or whatever it is. So if I'm saying 90-day 100 call, it means that 100 is referring to the exercise price. That's how we refer to options. Yeah. So my question is, what is the time value? What is the time value of the 100 call that you're looking at here? Okay, 3 participants have raised their hands. We'll look at them. One is Abha has also joined in. Okay, Aman is there. Okay, fine. And before that, we have Mithali also. Yes, Vipul, what is your answer? What happened to Vipul?
Sir, 1 second.
Okay.
So may I?
Yeah, Vipul, but won't be a quiz contest. Your time has passed. We'll go to Mithali.
Sir, 16.68.
Is the time value. Okay. And okay, then next is 1 sec. Then next is we go to AA.
9090.
According to you, the time value of this 100 call is what?
9090.
9390.
90, sir, 90.
90. The time value of the call is 90. Okay. Okay. And AA. Okay, we'll come to Janvi later. And then now we'll go to Abha.
Sir, can I?
Sir, according to me, it is 16.68.
It is 16.68. Okay.
Sir,
Yeah, 1 second. I'm just coming to you, Vipul. 1 second. Yes, Vipul, what are you saying?
94.6.
94.6. Is that what you're saying?
Yes.
Okay. 94.6. Okay, 1 minute. 1 second. We'll come to everybody one by one. Next was Janvi had raised her hand after that. Okay, Janvi Singh, what were you saying? 1 minute. Janvi is saying the time value of the 100 call is 90. Okay, 1 minute. Okay. All right. Now next is we'll look at other people. We'll look at Aman now. Oh, okay. Sorry. Before Aman is Srishti actually. Srishti has raised her hand before Aman, I think. So we'll go with Srishti first. Yes, Srishti. What is your answer?
Sir, my answer is 16.68.
16.68. 1 minute. I think in between I saw Utsav also raise his hand, but we'll go to Aman next.
Sir, according to me, it's 90, sir.
It is 90.
Yes, sir.
Remember, the question is, what is the time value of the 100? Okay. And
Yes, sir.
you now the lingo of option markets. If I'm talking about the 100 call, that means that 100 is referring to the strike price. Okay, 1 minute. Let's look at the people who have raised their hands. We have Priya and Sambhavna. Before that, did Utsav wanted? Did Utsav had you raised your hand, Utsav, earlier? I thought I saw.
Yes, sir, but sir, I'm not sure if I am right or not.
Okay, so you have withdrawn your hand.
Yes, sir. It is as far as I remember for time value, it is the intrinsic minus the premium that we have. So according to me, it should be 6.68. I think.
Okay, fine. We'll register your answer, then we'll come back and discuss. Okay. All right. Okay. 1 sec. Let's go to Priya.
So according to me, 16.68.
Okay. 1 minute. Okay. Next, Sambhavna.
Sir, it's 6.68.
Sambhavna is saying 6.68. So same as Utsav, but she has no doubt. Utsav has some doubt. Okay.
Yes, sir.
Utsav has some doubt, but Sambhavna has no doubt. Okay. Now let's talk to Gaurav. Yes.
Sir, same 6.68.
Gaurav is also 6.68. He also has no doubt. Very good. Okay. Good. Better not to have a doubt. If you have, even if you're wrong, you should be wrong without a doubt. That is very important. Okay.
Sir, actually, my answer was quite unique as compared to the previous answers. That is why I got a bit of doubt in my mind.
Your answer was what?
6.68. My answer was a bit unique from the answers that I heard previously. So I got a bit doubtful about my answer.
That's okay, but there's an important lesson here for everybody that you go with what you think is right. Okay, it's very important to have independence of thought, because you may be surrounded by a lot of people who don't have the right impression of what's going on. So it's very important that you do not get swayed by what other people are thinking. Okay, so please make sure you don't make this mistake. I'll come to Mitali's having some network problems. Okay, fine. We'll repeat that answer. Anyway, everything is captured on video anyway. You can replay it. So here there's a very important lesson for everybody. Maybe it applies to some people other than Utsav also. At least he's very honest about it. So maybe other people have the same issue, but they're not talking about it. But I'm just telling everybody that this is a very important thing in life. You only have one life. Okay, so you make sure you live your life making your own mistakes. Okay, everybody's going to make mistakes. Don't worry about that. But you make sure that Gagan is not living his life making Varun's mistakes. He should make his own mistakes. You decide whatever you think is right, just do it. Doesn't matter if you're wrong. But don't get swayed by what other people think. Then you'll have a real problem, because then you'll become just like part of the herd. You heard about the herd mentality? That everybody follows the crowd. So you should not do that. You should take your own view and be confident. Even if everybody disagrees with you, doesn't matter. If you think what your view is correct, because you're not a madman. You have come to your view with some kind of reasoning. So you should trust your reasoning and you should be confident about it. Okay. So spending a little bit of time on this. This has nothing to do with finance, but it's part of your training. Yes, Janvi, what is your problem? Yes, Janvi, you want to say something? You raised your hand. Janvi Singh. Because Ummat, we call Ummat. Yeah, yes. What is chat? Okay. It will be, now Janvi has changed her answer to 6.68. You just checked it. You're not supposed to check it. You're supposed to do it on your own. Where did you check it? Okay, fine. She has corrected her answer. That's fine. Okay. You checked the formula. Okay, fine. Great. It looks like I have to keep the chat open also, I guess. Otherwise I have to keep clicking on the chat. And the chat tends to, pin itself to the top. and I can't see anything else. The chat is a big problem actually. The chat tends to pin itself to the thing. Okay, let me, yeah, I have to minimize it. I'll keep it open and I'll minimize it. Okay, guys, so we'll stop this exercise right now, and we'll stop and we'll talk about all right. Okay, so let's discuss the right answer. It's a very simple answer. I'm surprised, but see, this is the important thing, that I'm spending so much time talking about all kinds of complicated matters. And here I find with a simple round of quizzing that even a basic question like this, you guys are not able to, many people are not able to answer. Only 3 people got the right answer first time. And out of that, 1 person was not very confident, okay? So, I think only 3 people got it, and then so this is very important that you have the basic concept should be very clear. It's a very simple logic. You can go back and check your notes later. Okay. In fact, I have not removed the notes. I should have because I had not planned to ask the question. So I should have removed these notes before I ask the question. I'll remove the notes from the access, and then I'll give you back the access after the class so that you can't refer to the notes. And okay, so, and that's likely to happen in the exam also. Okay, so please make sure you make your own notes because you will not have, this time it will be a closed book exam. So that's why I'm encouraging you to make your own notes because you will not have access to the notes during the exam. So what is happening here? Where are we? Okay, let's just look at the option formula. You can check the notes later. It's very simple. What was your formula? In fact, it's there in these notes, okay? This is the formula. Option premium is equal to IV plus TV. And this you should remember all the time. This is a very basic formula. It comes in handy in many situations, okay? Conceptually understanding what is going on in the option market, okay? And I've already told you we had a long discussion on what affects the TV, what affects the IV. You can practice all that. But here, this is the formula that is required for this particular discussion. Option premium is IV plus TV. Now, you already were informed by many of your batchmates that the IV of this option was 10. And again, don't memorize exercise price minus underlying price. Don't memorize it like that. Always memorize it. What you should remember is the process. What is the IV? IV, I already mentioned this earlier in today's class. If you exercise this option, are you going to make, if you exercise this option and then sell the underlying position or buy the underlying position, okay, in the market, you square the underlying position. First, you exercise the option, whether it's a call or a put. If it's a put, you'll be selling. If it's a call, you'll be buying. Then whatever you do, buy or sell through the exercise process, then think about reversing that in the underlying market, whatever the price is there. Then as a result of this process, do you make money? If you make any kind of positive profit through this process, then that's the IV. But if you make a zero profit or a negative profit, then the IV is written as 0. Okay, so that's the IV part. So this one you should remember. Don't memorize the formula, memorize the process. Okay, how do you arrive at IV? If you have to memorize. Once you do that, you don't really have to memorize it. Okay, then IV plus TV. So what you see here is IV is 10. Okay, because you can make $10 profit by exercising this option right now. IV is 10 and OP is option premium. We are talking about the call only. The option premium is 16.68. So therefore, if the option premium is IV plus TV and the IV is 10, then the TV must be 6.68, the balance. Okay, so the TV is always calculated as a residual. You can see this in the market. Okay, you can calculate this because you know what option it is. Okay, 100 strike or 90 strike or whatever it is. You can see this in the market. You can calculate this, and so therefore the TV becomes OP minus IV. Okay, so in this case, OP minus IV gives you 6.66. So Gaurav and Sambhavna had the right answer. Janvi came there later on after looking at the formula. But good, at least she was honest about that. Then I went and checked the formula. That's good that you have this that much honesty. So, and then Utsav also knew the right answer, but he was not sure. So please remember, Utsav, the most important learning for you from this is don't give a damn about what other people are saying or what other people are thinking, okay? The views of other people are not important. What matters is your own opinion, and which should be formed with some kind of analysis and reasoning. Once you have formed that opinion, and then to hell with what other people are thinking, because this is otherwise you'll get into all kinds of problems in life. Okay. So okay, so that's our discussion. So now, what is the background for our discussion? The background is this: that one of the other decision problems you will face, because the subtopic here is, where is the subtopic? Yeah, essentially additional decision problems in option trading. That's our topic essentially, okay? So we have these 4 decision problems that are connected to the buy-sell problem, okay? Should I buy or sell options? For this, you need to look at this. What option should I buy or sell, calls or puts? For that, you need to do this directionally on the underlying. Then what expiry and what strike? Okay, so that's at the buying stage. So 4 decision problems under the buy-sell bias for options. Then after that, at the time of liquidation, you have another problem, which is, should I liquidate, or should I do early exercise, or should I square the option position in the market? Okay, in this case, you're not doing early exercise, you're not exercising the option, you're selling off the option itself. So I'm telling you that the reason I'm telling you, so we are now discussing the reason why people don't usually do early exercise, okay? So you can see that from here, from this option, and in that context, we had to go into the discussion of the option premium, okay? And what is the composition of the option premium? And so then quickly recapping the concepts of IV and TV. So here you can see straight away why people always choose, generally, not always, but generally they choose this. There can be some exceptions, but in general they will choose 5.2. Why? Because look at the 2 options. Okay, let's do early exercise here. Now the option premium is 16.68. Now if I do early exercise, how much money do I make? Here there's no points. Let's ask Akshita and let's see if she has woken up. If I do early exercise, how much money do I make? Krish, how much money do I make if I do early exercise? What happened? Okay, so anybody else? Let's look at the people who have Varun. How much money will I make if I do early exercise here? Okay. So let's ask some people who we know are awake. Let's ask Utsav, how much money will I make if I do early exercise here?
Sir, if you do early, sir, 6.68 only, plus 10, 16.68.
If I do early exercise, what am I doing? What is involved in doing early exercise? This option has 90 days still to go, but I'm impatient.
Yes,
I want to do early exercise. So
Sir, it does not include time value, right?
yeah. So what Mithali is saying, so ask Mithali there. Then how much money will I make if I do early exercise in this case?
sir, 10 rupees.
10 rupees. Okay, so $10.
Yes, sir.
Yes, sir.
10.
$10. Sorry, sir, $10.
Sir, 10 minus 6.6. Sorry, 16.68 minus
6.68.
Yes.
1 minute. Now let's not get confused. So $10, 10 rupees doesn't matter. 10 is fine actually. I was just, it's not so important. Okay. So Utsav is saying we make $10 if I do early exercise. Now what is Mithali saying? How much will we make if I do early exercise?
Just the same.
10. Akshita is not on mute actually. Just tell her to put it on mute. So because she must have gone away somewhere and she's not on mute. Okay.
Sir, actually, she might not have connected the audio. That's why it's not showing audio sign.
Okay. All right, fine, no problem. Okay, so yes, so in this case, if I do early exercise, we are trying to understand why people normally don't do early exercise, even though you have an American option. Because if you do early exercise, you're only making $10. Correct? Okay, so example of the option. Okay, so the example that we are discussing is, okay, OP is equal to 16.68. Okay, if I do early exercise and IV is equal to 10. Okay, so if I do early exercise, so you can think about it this way also, in terms of when you think about the benefits, pros and cons. Early exercise captures only $10, correct? You have seen this now. Early exercise captures only $10. Okay, reversing option position in market. So everyone is clear about that. That if I do early exercise, that means I exercise the option, I buy the underlying at 100, then I sell the underlying in the market at 110, ignoring commissions and other transaction costs. I make $10 if I do early exercise. Now I've lost the option because I've exercised it. The other option, the other alternative is to sell the square the option. If I'm long the option, I want to square the option in the market. So in that case, how much do I make? Ignoring bid offer spread. Yes, let's ask Gagan. How much do I make if I square the option position in the market? Captures. Sorry. Yes, Gagan. Okay, so I got on mute because there's a little bit of background noise here. Gagan is also sleeping. Lots of people are sleeping in online classes, but that's in a way, if you don't make it up later, that's your loss actually. But anyway, so who do we ask? I actually almost want to see who is sleeping so that I don't ask the people who are sleeping. Then who do we ask now? Who is not sleeping? Okay, let's ask Kritika. How much profit will I capture if I square the option position in the market, ignoring bid offer spreads? Kritika, you're also sleeping. Okay, let's ask Rajat. What has happened to Rajat? Most people seem to be asleep these days. So many people sleeping. Okay. Who do we now? It's a challenge now for me. Let's ask Shaurya. Shaurya.
Yes, sir.
Yeah, answer this question. We saw that if I do, as we were told by Vitali and Utsav, that if I do early exercise, now I'm considering there's two options. I have the option in my hand. I'm long the option. I can either do early exercise or I can reverse the option position in the market. The parameters of this option are as such. The price of the option is $16.68 and the IV is $10. Okay, and somebody has come. So Kritika has come back on chat. So Kritika, do you know what is the how much money will I make if we reverse the option position in the market? In the meantime, while Kritika figures it out, we will ask Shaurya. So this is the question. These are the parameters of the option. Premium is 16.68, intrinsic value is $10. Now I'm considering these two. The second option, 5.2, if I reverse the option in the market, how much money will I make? Ignoring bid offer spreads.
Okay, so can you repeat the part again?
No, question is, if I reverse the option position in the market, if I square I'm long the option. Okay, so if I square the option position in the market, ignoring bid offer spreads, okay, or assuming that this price is a choice price, okay, assuming that this is a choice price, this is also something for you to learn, that 16.68 is a choice price. Anybody knows what a choice price is? A market maker quotes you a choice price. So you ask him for a price on Microsoft options, 90-day Microsoft call, 100 call for Microsoft, 90 days expiry, and he tells you that it's a choice price. Choice price means that, anybody knows what a choice price is? Choice price means that bid is equal to offer, is equal to price. Which means essentially that if the guy gives you a choice price quote of 1668, so the guy will respond. You will ask him, give me a price for, give me a two-way price for 90-day 100 call on Microsoft. That guy will come back and say 1668 choice. What that means is that you can either bid is equal to 16.68 and offer is also equal to 16.68, which means essentially he's giving you a choice. I'm showing you one price. You can either sell to me at that price or you can buy from me at that price, which is a very special kind of price, okay? That in the market, normally you will have a price which will be something like maybe 1662 bid and maybe 1674 offer. That would be the normal kind of, there is a spread between bid and offer, which is how the market maker makes money. If this guy is quoting you a choice price, he's giving you a very good deal. He's actually saying 1668 choice, which means you can either sell at 60. So it's an extreme example of a narrow bid offer spread. You notice, remember in the past, in Siddharth has talked about narrow bid offer spreads as an indication of a liquid market. Now this is the extreme case of a narrow bid offer spread. There is no bid offer. The bid offer spread is zero. That's called a choice price. When a market maker quotes you this price, that's why the for instance, ethics and professionalism, okay? So bid offers price. So let me write this here in case any of you, so you should know this also. Ethics and professionalism require that you must trade on such prices. Do not pass on them. Okay, so the point is, in the markets, these I'm talking about, we are supposed to teach you all about ethics and code of conduct as well. So I'm just telling you the traditions of the market. If you are trading in the wholesale market and you call somebody, even as a retail customer, if you call a bank and you ask him for a price on in any market, it could be anywhere, spot foreign exchange, stock options, bond futures, anything. And the market maker quotes you a choice price. That means bid offer spread is zero. Ethics and professionalism require you have called them up. Okay, so Nikita has called Utsav on the market making desk, and Utsav quotes a choice price. Now it is Nikita's ethical obligation not to pass, because she asked for she called to check the price, but she's asking for a trading price, and Utsav has quoted a choice price. Now it is Nikita's ethical obligation to trade on that price. She must do something, either buy or sell. She should not pass on the price, although legally she is entitled to pass. Okay, so passing, when you say passing, you say thanks nothing. Okay, usually when you pass, you say thanks nothing. Okay, that means you're basically, Nikita calls Utsav for the price, Utsav quotes a price, Nikita doesn't want to deal on the price, so she says thanks nothing and hangs up. But this kind of, if somebody quotes your, this is okay if you have a normal bid offers price, but if somebody quotes your choice price, you should not decline that price. You must trade on that price. Okay, so this is basically about ethics and professionalism. You are not required legally to trade on them. Okay, do not pass. If you pass, it's done by. Pass is done by saying thanks, nothing. You should not pass. Okay, now let me clarify. There is, but though there is no legal obligation to trade. So we're not, now, if you remember, when we were doing lab, we discussed, one of the distinctions we discussed was the distinction between morality and legality. Okay, so morality typically is what we're talking about. When you're talking about ethics and professionalism, we're talking about moral conduct. Now, so even if something, there's no legal obligation to do something, there may be an ethical obligation to do it. So that's the kind of distinction we're talking about here. Okay, so you learned something new again, a little bit of contextual knowledge and a little bit about ethics and professionalism and how the markets operate. These are all real life things which you should be aware of in case you decide to have anything to do with financial markets. Even if you're a corporate treasurer, the same rules apply to you when you're dealing with your bank. Okay, so going back, we had asked some questions we had asked a question to Shaurya, is that if I liquidate the option position in the market, how much will I make? You have an answer, Shaurya?
Liquidate an option position, and the option position is that 16.68 is the price. Okay. So if we liquidate it,
how much do I, what is my kind of revenue or what is my cash flow from liquidating the option? Okay, so we are talking about just the revenue side of it, because when people answered IV is equal to 10, when people answered that, when Mitali and Utsav told us that if we do early exercise, we will make $10, that here we are assuming that the cost of the option is zero for us, okay? So, because technically you have to subtract from that $10 the cost of buying the option, but we are assuming that we have bought the option for zero, okay? Just for the sake of this example we are discussing, we are assuming that we have bought the option for zero. So my question to Shaurya is, if I bought the option for zero, then I reverse this option right now in the market, how much do I make? How much profit do I make?
16.68 only.
16.68. Okay, good. So very, as you can see, it was actually a very difficult question, but at least you're awake and at least you have answered it. Maybe my the way of asking the question was also not clear. Okay, so that's clear. So now you guys understand. Okay, now I'm not going to ask any further questions on this point at least. Okay, so the point is, now you understand why I'm saying this. Because when you early exercise captures only $10, but reverse position in the market captures $16.68. Okay, so this is generally going to be true unless this thing is very low. Unless this thing is very low. So if you make this like one day left, okay, now you can see that the time value here is only 1 cent. Okay, in this kind of situation, you may do one early exercise. Then again, you have to look at the commission costs of early exercise versus selling the option. You have to do all those calculations. In our calculations, we have ignored commission costs and other transaction costs. In practice, when you exercise options, there may be some costs. You have to check all that information when you're trading options from the exchange. In this project, you don't have to worry about it because I'm not allowing you to exercise. You buy the option and you sell the option. But we are learning theory in this course, which goes beyond your particular project trading. So you have to learn this theory, that why even for American options, people don't exercise early, because by exercising early, you lose the time value. Okay, that's basically the thing. This is the point that I was trying to drive home. Okay, that if you do this, you capture the time value, and the intrinsic value of the option, whereas 5.1 captures only the intrinsic value. So that's a point to understand here. Okay, right. So let's look at very quickly. Let's start the next topic. Okay, we have 4 minutes. We can start. I can give you a quick. We can actually finish off this topic. It's a very short topic. This is about the relationship of the SPX and the VIX. We are talking about a general concept of relationship between. This is true for stock options. Okay, for equity options, a loose general relationship. The reason I'm using all these qualifying words like loose and general is because this is not, you can't rely on this all the time. Okay, it happens quite a lot of the time. Okay, exists. What is that relationship? An inverse relationship between underlying asset price, moves in the underlying asset price. So I'm telling you the theoretical part, then I'll explain the concept with an example. Moves in the underlying asset price and moves in the corresponding meaning referring to the same underlying asset price, corresponding I-wall index. Okay, which means options on the underlying asset price, average the prices of all those options, compute an I-wall index, and then plot that. Okay, so what you see here is it's the same as this, and later on we can just recap this also for the SPX and the VIX, but this chart is not working today, so I'll explain. So what are we talking about in general theoretical terms? We are saying that for equity options, okay, there is a loose general relationship between, an inverse relationship between moves in the underlying asset price. Okay, so inverse relationship. So first I'm giving you the theory, which is a little, when I write it, it's a little harder to understand. It's for equity options, loose general relationship, moves in the corresponding I-wall index. What does that mean? It means generally that that you notice something here, as this thing was declining here, as you see, this is the COVID decline. Okay, as the stock price of Microsoft was declining, the I-wall index was shooting up, and you see the high in the I-wall index. This is happening at the same time, approximately at the same time as the low in the underlying asset price. So this is visually, it's much easier for you to understand and retain, but it's also important that we understand the theory, and we are able to discuss the theory in a general sense. Okay, so this is the point I'm trying to raise, and the same thing, this thing is only talking about, hopefully this link works, and you can see the same thing as a relationship between the SPX and the VIX, because remember, the VIX index is the I-wall index for options on the SPX is the S&P 500 index. Okay, so this is the S&P 500 index, and so therefore the same thing is existing here. When equity prices go down, the corresponding option prices go up. So I'll just wrap it up in under 1 minute. So that's the point we're trying to illustrate here, that when this goes up, when I-wall indexes shoot up and the underlying asset prices tend to fall. And the general theory behind this is that there's a panic, the fall in the underlying asset price, okay, We'll do this later. You guys have another class. We will complete this in the next. We'll wrap this up in the next class before we move on to the next topic. Okay. So your class is dismissed. You can leave. And anybody who has a conceptual question or any other question. So first we'll deal with the conceptual questions. So the class is dismissed. You guys can all go. And those who have questions can remain. And we will take the conceptual questions first so that we will keep it as part of the recording. Anybody has any kind of concept questions? Yes? Nobody? Okay, good.
Sir, I have a question, sir.
Yeah.
Sir, while asking Sorjo, you asked that the option was brought at ₹0.
Yeah.
So, sir, how is that possible that I am getting an option for free?
No. It's not possible. I was just saying that we are assuming that for the purposes of this exercise. That's all.
Okay, sir. Okay.
It's not possible. I just wanted to make it easier for you to calculate the profit, because technically when I was asking you guys, how much money do I make? Now it's possible that you might have understood that to mean other than revenue. Okay? Because from the revenue you have to deduct cost in order to arrive at profit. So I wanted to make the cost equal to 0 so that effectively revenue and profit become the same.
Okay, sir.
Only for discussing this particular example, making it easier to understand. That's all. Yeah. In real life, you will not get free options unless you're dealing with some idiot on the other side. Then, yeah.
Okay, sir. Thank you, sir.
Okay, welcome. No other question? Okay. So, Mithali, you're still here regarding your problem?
Yes, sir. I just want to inform.
Okay, 1 minute. So, anybody else has any other questions, or I'll stop the recording? Okay.